What is going on, YouTube? I'm Mike with Penner Investments, and today I'm going to talk about rolling covered calls and the wheel strategy. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. Let's dive in. With the market making new 52 weeks highs recently, many covered calls are starting to get to be in the money or close to being in the money. I believe we are due for a short-term pullback with the market continuing higher through 2024. With the Fed talking about having rate cuts this year, this is a big positive for corporations and is also a big plus for the stock market. When companies can borrow and finance at lower rates, those savings make them more profitable, driving up stock prices. I currently have a few covered calls that are in the money, so currently I'm looking at rolling up in strike price and out further in time on the expiration date, while still looking at taking a credit for this trade. How I decide to roll the covered call or let it get called away is pretty simple. If I can roll the option up in strike price and out further in time for a credit, I look at doing just that. If I cannot get a credit, I let it get called away and continue with the wheel strategy by selling cash secured puts right back on the stock, and preferably on a day where the stock is down 2% or greater. But for me to roll a covered call, I like to make a minimum of 1% for every month that I roll the call out. This 1% can come from any combination of strike price and or premium. For example, I currently have 200 shares of Chevron that is trading at almost $152 a share. 100 shares is worth $15,200, so 1% of that would be $152. I would need $152 for every month that I move this trade out. This is the minimum that I would consider worth my time to keep the stock versus just letting it get called away. You might ask, why wouldn't I just let it get called away to begin with? There could be a few different reasons. It pays a nice dividend for one, and I want to keep collecting that, or I have not owned the stock for a year and may not want to pay the short-term capital gains. In this example, I can roll the option out for 2 months. I can move the strike price up for $5 from 155 to the 160 strike as well, which would easily beat the 1% rule. I also can take in a $48 credit on top of all this, making this a win-win in my opinion. I like to look at all the benefits from doing this trade. I get to roll the call price up $5, which is $500 more in my pocket if the stock gets called away, or if it gets in the money and then gets called away. I get the dividend by still owning the stock, and then I delay any tax gains that I have to pay quarterly estimates on. As always, if there's ever anything you'd like me to discuss further, drop a comment in the box below. Thanks for watching, and good luck trading.